Hello and welcome to the American Compass podcast. My name is Oren. I'm executive director at American Compass. And today we have a terrific episode for you talking about dollar as the reserve currency with who I would consider perhaps the leading expert on the question, Michael Pettis, senior fellow at the Carnegie Endowment. Michael, thanks so much for joining us to talk about
Thank
this.
you.
This is the sort of topic I think on one hand gets very sort of wonky and technical, but also is super important, and I think people are increasingly connecting to it at a conceptual level. In Washington, certainly, it's the sort of thing that some of the nerdy folks are starting to scratch their heads about at the bar after work, and so wanted to sort of dig into it a little bit. The dollar is what's called the world's reserve currency. It has been called the exorbitant privilege. The world conducts its affairs in dollars, and that means we borrow them cheaply and pay them back as we want to some extent. But it's increasingly clear, I think, that there are some pretty serious costs, and it's not necessarily to our benefit in the long run. And there's certainly things policymakers can do about it. So maybe let's start here. What does it actually mean to say the dollar is the reserve currency?
Well, the it's not just the dollar. There's a group of currencies that punch above their weight. And when I tell you that group of currencies, you'll immediately understand the connection among them. It's basically the US dollar, the British pound, the Canadian dollar, and the Australian dollar. And what those four countries have in common is that, contrary to what economic theory would tell us, they represent something like 60 to 80% of all global trade deficits. That should surprise us because what economic theory tells us is that developing countries should have high investment needs and scarce domestic savings. So they should be net importers of capital from the rich countries. So basically, the way a well functioning trading system should work is that rich countries should be exporting capital to poor countries, and consequently, rich countries should be running surpluses and poor countries running deficits. And that was true until around the 1970s, until things turned around pretty radically. So now we have what is an anomaly, and that is that you have a group of rich countries that absorb a huge amount of excess savings from other rich and poor countries. Now, why do they do that? I would argue that the reason they do that is because there have been a number of policies implemented around the world which we're familiar with. In the 1930s, we call those beggar thy neighbor policies, the point of which is to make the manufacturing sector extremely competitive at the expense of domestic demand. And the result is countries that follow these policies have to run trade surpluses. But you can't run a trade surplus unless you acquire foreign assets. And so, where do you want to acquire foreign assets? Well, you want to acquire them in economies that have extremely flexible financial systems, very good legal systems, very good governance. And that's basically the US and the other so called Anglophone economies. So the rest of the world runs surpluses and acquires assets in the US. But the obverse of that is the US has no choice but to run deficits. You'll often hear people say the US imports foreign capital because it saves too little. But it's actually the reverse of that. The US saves too little because it imports foreign capital. And we can go later on into
Right.
what that means, but that has important consequences for the US economy.
Right. So let's unpack a few elements of that, because I think this is it. At the end of the day, it's intuitive, but it starts out counterintuitive, I think, for a lot of folks, recognizing particular this relationship between what's called the current account, the actual balance in trade of goods and services, and then the capital account, the flow of assets. And the core point that I think is important to recognize is we typically in popular conversation talk about the current account. We talk about trade deficits, and we say, okay, if the United States is running a trade deficit, that means we are importing a lot more than we're exporting. And some people actually say, well, that's a great thing. We're getting more stuff, and we had to send back less stuff. And the important thing to recognize is that, of course, that can't be true. It can't be the case that people are sending us more stuff than we are sending them. The question is what is being sent by who to whom. And so if people are sending us more goods and services than we are sending back, then what we're sending back instead are assets.
Yes.
And so in a sense, the trade is okay, the rest of the world manufactures a lot of stuff that we consume here in the United States. Obviously, we manufacture stuff that others consume, but on balance, a significant share of what we send back is assets, meaning ownership of corporate equities, ownership of real estate, and then importantly, debt. The funny thing to remember is that if when the US government issues a treasury bond, that's an asset. It is us borrowing, but what it means is it's an IOU. So in a sense, we are receiving manufactured goods from the world and sending back a piece of paper, a US Treasury bond, saying we will pay you back at we will pay you back at some point in the future. And by pay you back, technically, in the short run, we mean dollars, but in the long run, we mean at some point we're going to have to make stuff and send it to you.
Yes, exactly. Um, I think one of the easiest ways to think about it is, let's remove the US and China from the equation because that's very political and we all have strong assumptions about that. Uh, uh, let's pretend there are two countries in the world, Germany and Spain. Um, in Germany in the 1990s and until the beginning of the 2000s was running a trade deficit. Um, and in 2003, they implemented a series of reforms that had a very important impact on the German trade deficit. And that is, they reformed, these were called labor reforms, which in reality were reforms aimed at reducing the ability of workers to raise wages, right? So before 2003, as German GDP rose, German wages rose just as quickly, which makes sense. As your productivity goes up, you should get paid more. But after the 2003 reforms, German GDP continued to rise, but wages flatlined. Now, this is really important because what it means is that there was a transfer of income from German workers to German manufacturers, which made German manufacturers much more competitive globally, but at the expense of wages. Now, normally that would be a problem for Germany. If Germany were a closed economy, they would be producing stuff, but they wouldn't be able to consume what they were producing. So eventually they would have to stop producing and let unemployment rise. But thanks to trade, Germany could get around that problem. Now, for reasons having to do with the EU and the existence of the euro, Germany basically bought assets in Spain and ran a surplus with Spain. Um, because German workers were becoming more and more competitive, or German business was becoming more and more competitive, Spanish businesses were unable to compete. Let me stop here and explain something that causes a lot of confusion. After 2003, German workers became cheaper than Spanish workers. Many people think that means that German wages were lower than Spanish wages, and they say, of course, that didn't happen. German wages were always higher than Spanish wages. But what matters is not the level of wages. What matters is the level of wages relative to productivity. And so, what happened in Germany, the gap between wages and productivity was much greater than in Spain. So, German workers became cheaper and German products became much more competitive in Spain. And so, because of the existence of the euro, there was nothing Spain could do about that, and it started to run the large deficits that corresponded to German surpluses. Now, this is really important because if Spain starts running large deficits, that means by definition that there is a gap between Spanish investment and Spanish savings. German savings are flowing into Spain, and that should either cause Spanish investment to go up or Spanish savings to go down. And this is what causes so much confusion because most economists assume that investment must go up. So running a deficit is a good thing. It allows you to invest more than you otherwise could. But that was true 100 years ago, 200 years ago. In advanced economies today, there is no savings constraint on investment. They invest as much as they need to invest. And when additional foreign savings come in, they don't increase their investment. But the gap between investment and savings must nonetheless occur. So, what ends up happening in a country like Spain is that rather than investment going up, savings goes down. Now, how does savings go down? We can talk about this later, but basically, there are three ways savings can go down. One way is with a rise in Spanish unemployment. So, as Spanish consumers buy more and more German goods, they buy fewer and fewer Spanish goods, and so Spanish factories have to fire workers. Workers have a negative savings rate, so that's how you balance the excess savings of Germany with the excess investment or the under savings of Spain. Most governments don't like to see unemployment go up. So there's two things they can do to beat that. One is to encourage household debt. So you see an increase in household debt as households increase consumption faster than their wages justify. And the other way is with an increase in the fiscal deficit. So the point that I want to make here is that because Germany became more competitive by lowering its wages, Spain had to resolve this either with an increase in investment, which didn't occur because Spanish investment was already more than sufficient for the needs of the economy, or with a reduction in savings, which could occur as a rise in unemployment, a rise in household debt, or a rise in the fiscal deficit. In the global economy, it's the US that mainly plays the role of Spain in this story. Roughly half of all of the excess savings in the world go to the US, and most of what's left go to the UK, Canada, and Australia. That means the US faces the same problem. It must absorb these excess savings. In the 19th century, it did so with an increase in investment because the US had very high investment needs as a developing economy. Uh, but in the 20th century, or certainly in the 21st century, that's no longer the case. So the US must absorb these savings with an increase in unemployment, or more likely with an increase in household debt and an increase in the fiscal deficit. So I would argue it's not a big surprise in the last 40 to 50 years, we've seen a surge in American debt. That surge in American debt corresponds to the surge in the American deficit, which is itself a consequence of surging surpluses in the rest of the world that are resolved by acquiring dollars.
Right. And so the first step there I think was key. I was going to say let's replace Spain with the US because of course what you were describing, we can get into causes and diagnoses and so forth, but as a descriptive matter, clearly this is what the US has experienced. It has experienced pressure, particularly in its manufacturing sector, that on one hand was leading to higher unemployment, and on the other hand was being offset by increases in household debt and fiscal
Right.
deficits. That seems clearly what has happened in the United States. I think a second thing that has to be said, and this goes to your point about the German side, is that as a descriptive matter, this is clearly what Germany and other countries are doing. We could have a debate whether it is actually wise for them in the long run to be doing it, but whether you are talking about Germany or South Korea or China, obviously, the export led model of economic policy that they believe will lead to growth and productivity gains and so forth is the policy that they are pursuing. And through a variety of mechanisms, some in the labor market, some through outright subsidies and other forms of industrial policy, they are aggressively trying to produce more than they consume. And they can do that because they have a market, primarily the US, and then, as you noted, these other Anglosphere economies that are playing the role of the deficit country on the flip side. The one other nuance I just wanted focus in on quickly because it goes to this sort of at first counterintuitive, later intuitive phenomenon, is how we've switched from talking about deficits to talking about savings. And the way that those are sort of the same thing, that if you think in abstract terms about what savings is, from the perspective of a producer country, let's take Germany in this case, by definition, if you've produced more than you've consumed, that difference at the household level we think of as savings, right? If
That's right.
I produce a lot or earn a lot of income, don't spend it all, that we say that that difference is what I've saved. From the perspective of a national economy, by default, if you just produced a lot of stuff and didn't consume it all, you'd have a lot of BMWs sitting in warehouses, which on one on one hand, I guess you could call savings. On the other hand, it would be a not very useful and rapidly depreciating form. And so that's where the trade element comes in. What you see is the BMWs get sold into other markets. And at the end of the day, in the short run, Germany might literally be getting dollars back. And some, they may hold some dollars as their savings, but by and large, what they're then going to do, and we're abstracting to the nation, sometimes it is the central bank, sometimes it's the corporations and households in the country, they're then going to take those dollars and use them to buy dollar denominated
That's
assets.
right.
And so at the end of the day, what has happened is the BMWs have come to the US, which is what we're essentially calling the savings from Germany's perspective. And in return, Germany finds itself with a pile of dollar denominated assets. And that sort of brings us back to where we started, I think, which is this question of the dollar as the reserve currency, or perhaps more importantly, it's to say dollar denominated assets and American assets as essentially the reserve asset, the form in which the rest of the world wants to hold this savings that it's producing. Is that sort of the right sequence of
Yeah,
steps?
that's exactly right. If you sell something, you have to get paid. And if you export a product, you get paid either in the form of imports or in the form of ownership of assets abroad. In the old days, it was gold, but we don't use gold anymore. So it's the ownership of foreign assets. In a well functioning trading environment, the purpose of exporting is in order to import. But if you want to supercharge your growth, one of the things you can do is make your exports much more competitive. Now, many people think that China is a big exporting nation because Chinese manufacturers are extremely efficient. And I think that's a mistake. They're not efficient, they're extremely subsidized, sometimes directly, but more importantly, in the form of very weak labor rights. If labor has very weak rights, then they can't raise wages, which is a subsidy for employers, of course. Very low interest rates, artificially low interest rates, are a transfer from net savers to net borrowers. And in an economy like China, the net savers are households and the net borrowers are businesses and the government. Excessive spending on infrastructure is another transfer from the country as a whole to the business sector as a whole. So all of these transfers subsidize the manufacturing sector. And the manufacturing sector becomes incredibly competitive. But it's competitive not because it's efficient. That's the important point. It's competitive because domestic wages are so low. So household income in China is much lower than it is, say, in the US, which means businesses are that much more competitive. Now, normally in a closed economy, if you don't consume enough to absorb everything you produce, then the result is you have to stop producing stuff, you have to close down factories, and you have to fire workers. In an open economy, you have another solution, and that is to export your excess savings or export your excess production. It's the same thing. And then the country that absorbs those excess savings is now the country that has to resolve the problem of the gap between supply and demand. And as I said, you resolve that either in the form of higher unemployment, higher household debt, or higher fiscal deficits. And the US plays that role not because it wants to play that role. You'll often hear economists say that the US runs deficits because Americans save too little. That shows they don't understand the dynamics of the balance of payments. If the US does not control its capital account, and it doesn't, if you want to invest in the US, you can do so anytime you want. So the US does not control the capital account. That means, by definition, the US cannot control the gap between investment and savings. Again, in the 19th century, foreign inflows cause investments to go up. Today, that doesn't happen, but they still cause the gap to expand. So savings must go down. And that's the role the US plays. When the rest of the world wants to improve its manufacturing competitiveness and increases its savings in doing so, the US must reduce its savings. It has no choice in order to absorb the excess savings globally. That's the role of the dollar.
Right. And so the question, I guess, is as a initial matter, why does that happen? And you could imagine a world in which the rest of the world wanted to accumulate its savings in some other way. And there are obviously a set of things that are unique about the US, some of which are policy choices. You mentioned we have our open capital account, some of which are just a geopolitical feature of the US as the, until at least recently, sort of by far largest, most dominant economy. Partly it is a function of the depth of our capital markets. At the end of the day, it is extremely easy to buy and sell dollars and dollar denominated assets with very little friction. Partly, obviously, it's the strength of our legal system. It's the commitment of our Federal Reserve to preserving the value of the dollar. There's sort of a whole host of reasons. Are there other things you'd add to that in terms of why we find ourselves playing this role?
No, that's basically it. So assume you're China, you run big trade surpluses in order to turbocharge your manufacturing sector. You've got to acquire assets. You can either import, but domestic demand is so weak that you can't import. So you must acquire foreign assets. Where are you going to acquire them? You could acquire them in developing economies. In fact, that's what you should do. The problem there is that it's very risky, and there's a pretty good chance that you won't get it back. You can't really acquire them net in Europe or Japan because those are both economies that run persistent surpluses. So where can you acquire them? You can acquire them in assets in countries that really protect your assets and don't have a problem running very large deficits. And once again, we come back to the Anglosphere. Those are the economies that do so. But this isn't without a cost. This is a tremendous cost to the US economy. And we all know that at some point it's not sustainable. So the question is, what does the US do about it? One of the good things that has happened in recent years, and partly thanks to your work, is that we're seeing a shift in the perception of the role of the US in global imbalances. So, whether you talk about the Democrats with their industrial policies or the Republicans with their trade policies, and basically there's no difference between the two. In both cases, there is a recognition that this has a significant cost for the US. One of the costs we've already discussed. The US has to choose between higher unemployment or, more likely, higher household debt or higher fiscal deficits. But the other cost you can see is very, very clear in the distribution of manufacturing globally. Um, so the way you think about this is to really simplify, assume that China runs large trade surpluses and needs to invest them. So they buy dollars. That causes the value of the dollar to go up, and in relative terms, the value of the renminbi to go down. This has significant implications on both the Chinese economy and on the US economy. A cheap renminbi is a way of transferring income from net importers to net exporters. So, who are net importers? All households are net importers. Who are net exporters? The tradable goods sector, manufacturers. So, in China, a cheap renminbi is a subsidy from household consumers to the manufacturing sector. In the US, it's the obverse. Whether we like it or not, the expensive dollar means that there is a transfer from net exporters to net importers. Again, net exporters are the manufacturing sector. Net importers are the household sector. All households are net importers. So what you end up having is that in China, consumers are subsidizing manufacturers. And in the US, manufacturers are subsidizing consumers. So it's no surprise at all that manufacturing is migrating towards those countries that subsidize it most, and consumption is migrating to those economies that subsidize consumption most. So you get these strange anomalies. The United States is 17%, I'm sorry, the United States is about 23% of the world, of global GDP. It accounts for 28, 29, 30% of global consumption and only 17% of global manufacturing. China, which is about 17% of the world, accounts for 13% of global consumption, and it accounts for an astonishing 31% of global manufacturing. Uh, Manufacturing on average is about 16% of global GDP. But if you look at surplus countries, in all of those economies, the manufacturing share of GDP is extremely high. In China, it's 28% of GDP. But then you look at the deficit countries, the US, it's 11% of GDP. England, it's about 9%. Australia and Canada, it's in that region. And it shouldn't be a surprise. In those economies that subsidize manufacturing, of course, manufacturing is going to migrate there. And in those economies that subsidize consumption, not surprisingly, consumption migrates there. So when people talk about Americans being inveterate consumers and reluctant to save, that's not true. The US, because of its role of absorber of global savings, has no choice but to become the consumer of last resort. It's the same thing.
Right. I guess the flip side of the argument I would be that, well, that sounds great, right? That and this is part of the case for the dollar status as an exorbitant privilege is, well, if we get to consume more, then that sounds pretty good. The argument, it seems to me, is not that consumption is bad. It's that, in a sense, deficit financed consumption is bad.
Right.
It's that consumption that is not met also by production may be fun in the short run, but has negative implications both for the fiscal health of the households and the nation in the long run, and for the trajectory of the economy's growth in the long run. That the sort of analog at the household level is, well, yes, if you get a credit card in the mail and it lets you buy buy a whole bunch of stuff, that you might say, hooray, I got this great TV. But if that led you to quit your job because you had this great credit card, and you also now had all this credit card debt, it would not, in fact, in hindsight, have been a great thing that the credit card arrived in the mail. Is
That's
is that oversimplified? It drives me nuts when I hear economists make these analogs to the household and not acknowledge this element of it, because it seems very straightforward. But I want to credit the economists with maybe having thought about it at least a little bit.
Well, most economists, and certainly most economists above a certain age, an age which I include myself, are locked into really a 19th century view of the balance of payments. So they don't really understand this. So their argument is that without the current account deficit or without the trade deficit, American consumption would be lower and American households would be worse off. But that's not true. The difference is that without the trade deficit, American consumption would be as high as ever, but it would be driven by higher wages rather than by higher debt. Because what you would end up having is American production would expand. And the idea that Americans exist only as consumers is, of course, total nonsense. You are both a consumer and a producer. So your consumption levels depends on your production levels plus your debt. So without the current account deficit, consumption would be as high as ever or even higher, except it would be driven by a rise in production rather than a rise in household or fiscal debt.
So this is a point that I've heard you make before, and really resonated with me and fascinated me. But I worry it's too easy, and so want to push you on it a little
Sure.
bit, because the same thing goes when you look at sort of the, at the national level, thinking about, the fiscal deficit and so forth. There's this idea that, well, we're only able to run these deficits because we have this trade deficit, and if we were to force things toward balance, we would also be sort of forcing ourselves into austerity. And the counterpoint I take it is, well, in essence, there's massive untapped productive capacity within the US economy. And partly you see that even in just, people out of the labor force entirely, people in less productive work than they could otherwise be doing. And in a sense, what you could see is a shift toward higher output and more
Right.
productivity, and therefore meet closing these deficits not by reducing consumption, but by increasing production. As a hypothetical, that certainly seems like a possibility. What worries me is it's not clear to me how to make the case that that is what would happen. That is, it also seems plausible to say, well, actually, no, the next thing that would happen is stuff would get more expensive and we'd have to cut back. How do you sort of mediate between those claims and argue for one versus the other as the likely path forward?
If we tried to resolve trade imbalances in a couple of months, it would be extremely painful, because what would end up happening is that we would import a lot less and we wouldn't be in a position to produce the consequences. So you'd see the austerity that you talk about. You might see a rise in unemployment. You'd probably see a rise in inflation, et cetera, et cetera. But remember, the US didn't go from surplus to deficit in a couple of months. It took several years. And over that period, we saw the undermining of a whole series of American industries. In the 1990s, for example, the US was the leading manufacturer of chemicals. Today, it doesn't do chemicals almost at all. And you can go industry by industry. So the solution is not to solve it overnight. The solution is to solve this problem over a several year period, so that what the US was able to do a few years ago and is no longer able to do because of massive subsidies to its foreign competitors, it ends up rebuilding. So, I would argue that neither the Republican or Democratic administrations are talking about resolving this within a couple of months or a few weeks. They're all talking about gradual adjustments so that over a 5 to 10 year period, we eliminate the imbalances. And if we do so, there's absolutely no reason in the world why the US cannot significantly increase its manufacturing. You will hear some economists say that actually advanced economies like the US, manufacturing naturally becomes a lower share of GDP. That just shows that many US economists don't really look at the rest of the world. If you look at other advanced economies like Germany, South Korea, Japan, the manufacturing share of GDP is much larger than it is in the US. Uh, it's not advanced economies that manufacture less. It's deficit economies that manufacture less. Surplus economies manufacture more. And the reason is precisely because in surplus economies, households subsidize the manufacturing sector, whereas in deficit economies, manufacturers subsidize household consumption.
So let's run through a few of the other counter arguments in terms of why we should like the dollar as the reserve currency, and like these deficits and so forth. I guess as a maybe as a preliminary matter, it seems to me there's two things we should distinguish. One, people always talk about, the role of money. It's both a medium of exchange and a store of value, and that seems to me to apply to this debate as well, because there's both the question of the dollar as the currency in which global trade is conducted as a medium of exchange. And there's separately this question of the dollar as the store of value, the thing that people want to be saving in. I guess one question I have for you is, do you think it's possible to separate those things somewhat? That is, could the dollar cease to be this massive reserve asset because the U.S. is absorbing the world's savings, but still for the many other reasons people like the U.S. infrastructure and role the dollar plays, the dollar actually remains to a significant extent the preferred sort of medium of payment in the global economy.
Well, that's not just a hypothetical question. We actually have experience there. The U.S. had capital controls until basically 1983. There were difficulties in moving money in and out of the U.S. And so what ended up happening is you saw the development of the euro dollar market, which was the dollar market outside of the US. When I first started in investment banking, the euro dollar market was extremely important. Its importance has faded away because there's no longer a distinction between offshore dollars and onshore dollars. But when there was, the dollar market dominated international transactions, maybe not to the extent that it does today, but to a significant extent. So it's possible for the US to impose the type of restrictions on foreign acquisitions of US assets without eliminating the role of the dollar in foreign transactions. But I think there we have to be realistic. The reason American banks dominate international finance is because the dollar dominates international transactions. And the reason the dollar dominates international transactions, there's two reasons. One is typical network effects, which aren't going to go away very quickly. But the other is the fact that you accumulate dollars to balance your surpluses. And if you eliminate the second fact, then clearly the role of the dollar globally will diminish. Now, is that a bad thing or a good thing? Well, most economists try to answer that it's bad or that it's good as if it were a question of religion. But it isn't. What we really have to do is think about what are the conditions under which that's a bad thing and what are the conditions in which that's a good thing. And it turns out it depends who you are. If you are a major US bank or a Wall Street firm, or if you are a major owner of movable capital, or if you are in the foreign affairs establishment, then the global role of the dollar is a very good thing. If you are an American farmer, worker, producer, small business, it's a bad thing. And so I think that's really how we have to think about the role of the dollar. It benefits certain constituencies in the US and it hurts other constituencies. So we have to decide as a country what's more important, the underlying economy and our manufacturing capacity, or our ability to dominate global finance and to impose financial sanctions on enemies. I personally would argue the former is more important than the latter, but the point is we need to have that debate.
Well, and what about the argument on the foreign policy side? I think those in the foreign policy establishment would say the power that they want the U.S. to exert globally ultimately redounds to everybody's benefit if it allows the U.S., for instance, to exert power without having to deploy militarily. And so, for instance, the role that the dollar plays in allowing the U.S. to impose sanctions has typically been a strong argument in favor of the reserve currency status. My sense in the lesson of the last couple of years in the context of sanctions imposed on Russia is that immediately when the U.S. imposed the sanctions, everyone said like, "Whoa, look at this! What an extraordinary display of dollar dominance." If anything, maybe we sort of slam the button too hard. But that quite quickly people discovered actually uh, Russia had no problem adjusting accordingly, and that whereas everyone is happy to sort of pretend that the dollar has this power when we're not using it, as soon as we actually tried to use it, it turned out not to be nearly as powerful as everybody had promised. Is that is that a fair interpretation of the lesson of the last couple of years?
Well, I think it is very powerful, and it continues to be very powerful. But there's an old market saw that credibility is maximized when you don't use it. To the extent that you use it, you undermine your own credibility. And that's occurred to a certain extent because countries like Russia, China, Iran are trying to protect themselves from the global power of the dollar. But I would add another thing, and that is the power of the dollar is not fixed, by God. The power of the dollar is determined really by the power of the U.S. economy and the credibility of the U.S. economy. And as the US economy relies more and more on a rise in household debt or fiscal deficits to generate growth, that seems to me it should undermine that credibility. And eventually we lose the ability to use the dollar as a source of global power. So, again, I would say, I can't answer the question one way or the other. All I can ask is, decide what you think is the source of American power. Has it been the American economy and its manufacturing capacity, or has it been its ability to wield financial power? If you think it's the former, you would want to reduce the US role in absorbing global savings imbalances. And if you think it's the latter, you would want to increase it. But that's the debate that we must have.
Yeah, that's a good point. And I guess the last argument that gets put in favor of the status quo is the idea that it essentially supplies the US with cheap capital for purposes of investment that we might need. I've always been perplexed by this claim for two reasons. One, that investment as a share of GDP has been in long-term secular decline in the US, despite this advantage that we supposedly have. And second, that of course we're coming out of, 10 years of zero interest rate policy. It seems like if anything, we have a sort of capital bubble problem where we are so awash in capital that we get negative distortions rather than productive investment. But how do you address that claim that, look, capital and investment are good? If you want a strong manufacturing sector, you need a lot of capital investment. We should be celebrating the world wanting to quote invest in the United States.
Again, that's a 19th century view which really hasn't adapted. So in the 19th century, the US had very high investment needs, but it had insufficient domestic savings to meet those investment needs. The cost of capital was too high. So when the British and the Dutch, and it was mostly the British and the Dutch, invested their savings in the US, that brought down the cost of capital and that increased investment. Um, that can occur under certain conditions when you are a developing country with very high investment needs. But as you pointed out, with all of this money pouring into the US, we don't see investment rising the way it rises in countries that are exporting capital. And I would say the reason is because in a country like the US, we no longer have all of these roads and bridges and dams that we still need to build. What drives investment, and particularly what drives business investment, is demand. So when you increase the amount of savings available to American businesses, they're only going to use it if demand is growing. And because that increase in savings corresponds to an increase in the trade deficit, demand typically isn't growing. So businesses are simply not going to invest. But there's another more important point, and that is, remember, inflows are equal to the excess of investment over savings. If inflows don't cause investment to go up, and they clearly don't, you mentioned the very low interest rates, but American companies are sitting on huge amounts of cash. Roughly 12% of assets consist of cash, and they don't act like they need to invest this. So when you increase the cash available to them, they're not going to invest anymore. And yet the gap between savings and investment has to rise. So what that means is that savings is going down. And as I said, one way savings can go down is through a rise in unemployment, but a more typical way is through a rise in household debt or in the fiscal deficit. So what's end up happening is that as foreigners invest in American debt rises by the amount of the investment. So the demand for debt goes up, but so does the supply, in which case there's no change in the interest rate. I would add one other really obvious point to that, Oren, and that is for those people who believe that foreign inflows reduce American interest rates, there would be a very simple experiment. Look at countries that are receiving foreign money. Look at advanced economies. Forget about developing economies. Look at advanced economies that are receiving foreign inflows, and look at advanced economies that are sending capital abroad. The latter's interest rate should be lower than the former's, right? Because they're receiving all of this capital from the former. And yet, if you look, you'll see that generally the interest rates in surplus countries is lower than the interest rate in deficit countries. That's certainly the case today. So that makes it very hard to believe that when Germany exports capital to the US, that raises German rates and lowers US rates, because that's clearly not what we're seeing. So the
Yeah.
idea that this helps finance American investment is total nonsense.
Well, I think your point about the cash that the corporate sector is already sitting on is especially important. It's really interesting to line up the now approaching $1 trillion trade deficit and therefore capital account surplus next to the roughly $1 trillion in annual stock buybacks
Right.
that corporations are professing they simply have no way to productively deploy the capital. And then, of course, where that lands, we've done a bunch of research on this at American Compass. In okay, well, if supposedly people defend buybacks on the grounds that, well, that lets someone else deploy the capital instead, but no one else does. It ends up landing one way or another in treasuries and financing fiscal deficits, which again, you might say, well, okay, then technically the government is quote investing, and of course, if the government were actually, quote, investing, that might be useful too, but the federal government serves to launder that investment into cash transfers back out to the public to be consumed. And so it essentially all comes back to the story that you started with, where the savings ends up landing back as household and fiscal debt that finances consumption, but has no productive capacity underlying it.
Yeah,
So
there's a series of papers done by Atif Mian, Sophia Amir, and Ludwig Strobe that address that issue. For most economists, an increase in savings by definition means an increase in investment. So if you increase the savings of businesses or if you increase savings of the rich, investment must go up. And what they show is that doesn't happen. Now, investment is always equal to savings. So what ends up happening is that if you increase the savings of certain groups, the savings of other groups go down. And that's what prevents investment from going up. And that's what we're seeing in countries like China. Chinese excess savings are coming to the US, and they're not resulting in an increase in American investment. They're resulting in a reduction in American savings. That's how savings and investment balances globally. And I would argue that that's bad, not just for the US, but also for China in the long term. It's bad for the global economy because it means that there's a systematic tendency to suppress demand. And the only way to overcome that demand suppression is with a rise in debt. So, in a funny way, China and the US are mirror opposites. In both countries, debt is rising too quickly. And in both countries, it's rising for obverse reasons, obverse but related reasons.
right, and so that's a great segue into the last thing I wanted to spend a couple minutes on. Maybe we'll have to continue discussing this, but wanted to touch on the question of okay, so what would one do about this? Because of course you can't just pass a resolution declaring you no longer wish to be the reserve currency or reserve asset base. So, from a policy perspective, you've alluded to the sorts of capital controls we've had in the past. American Compass has written a lot on the sort of, and you've written for us on the different mechanisms that are available both on the current account side and the capital account side to sort of discourage these imbalances. Where do you start for a policymaker who's nodding along and saying, yeah, I actually don't want the U.S. to be playing this role in the global economy. What is the logical next step?
Well, I think there are three possible ways of resolving this. One way is through import tariffs. Um, if you increase import tariffs enough, It's the equivalent of depreciating the dollar or appreciating foreign currencies. And remember, as you appreciate currencies, you switch resources from the productive side of the economy to the demand side of the economy, and you balance it. Now, that requires an enormous amount of tariffs, and that requires punishing all of our trade partners, the good ones and the bad ones, the ones that are following mercantilist policies and the ones that are not. It's effective, but it's pretty, it's maybe not terribly nuanced. The second solution is if the problem is that foreigners are dumping their excess savings into the US economy, then just prevent that. So, one way of doing that would be to impose taxes on foreign capital entering into the country. There's a number of ways of doing it. And I always remind people because, they say this is something the US has never done. On the contrary, the US has often done it. It was only in 1983 that we stopped imposing any form of capital controls. We can go back to those previous periods. Um, the third solution, which is, I think, the best solution, is to renegotiate global trade agreements. And we don't need everyone to agree. We just need the major deficit countries to agree. Because once they agree, then the surplus countries have to conform. They have no choice. And that is to go back to a system that Keynes proposed back in 1944, in which countries that run sustained deficits pay a penalty until they adjust those deficits. So basically, we go to a world of trade in which countries agree that they're not going to use trade to externalize the costs of domestic subsidies. They're going to use trade for reasons of comparative advantage. You exchange goods for your benefit. So those are the different ways of doing it. As I said, the third way I think is the best way. The second way I think is the easiest way for the US to do it unilaterally. And then the first way I think is the easiest way to explain to policymakers.
Yeah, interesting. And so on the third one, just you were saying, it's the deficit countries that pay a penalty, or the surplus countries that pay a
Um,
penalty?
uh, in Keynes's original proposal, it was both, but I think he understood that it was really surplus countries that were engaged in what was called in the 1930s beggar thy neighbor policies. In other words, my way of dealing with unemployment is to export it to you. And Keynes argued that we have to stop those types of policies. So the best way to do it is that countries that run persistent surpluses, which are basically not countries that are efficient in manufacturing, but rather countries that have used domestic demand to subsidize manufacturing, have to resolve the imbalances domestically. They cannot resolve them externally.
And so for a trade agreement, let's say the Anglo countries as a starting point were to want to pursue this approach. What does that actually look like? Because of course you can't impose. One way of thinking about the imposition of the penalty is that it would look like a tariff in a sense, or what would it? What are the actual mechanics of that structure if the current deficit countries wanted to attempt to sort of impose it?
The most obvious way would be for deficit countries to agree to a trade barrier to countries that do not join the trade agreement, and countries that join the trade agreement have to commit to balancing, not on a bilateral basis, but on an overall basis, imports with exports. And to the extent that they don't, there are a number of ways that penalties can be paid. Keynes proposed some, other people have proposed other ways, but basically they would pay significant penalties on the extent of their imbalances, surpluses, or deficits. The point is not
And so
the point is not to penalize countries. The point is to increase the trade agreement uh, among countries that agree that the purpose of exports is to pay for imports. It's not to acquire assets abroad.
in the short run, you might see the countries that are in the agreement imposing some sort of tariff as a barrier against those that are outside of it. But to your point, the long run equilibrium goal is not tariffs all over the place. It's people coming into the agreement and therefore agreeing to conduct themselves by the rules of an actually sensible global economic order rather than the WTO based one that we have today.
Yeah, the irony is that many people argue that these are protectionist policies that undermine a well functioning global trading system. But it's exactly the opposite. We don't have a well functioning trading system. In a well functioning trading system, you can't run persistent surpluses. A well functioning trading system operates on comparative advantage. And the benefits of comparative advantage are realized only in the exchange of goods, not in the production of goods. So, what we would be doing is forcing the world back into really a kind of optimal free trade area. And you have to do that by penalizing countries that currently undermine global free trade.
Right. Terrific. Well, we have to leave it there. This has been a phenomenal conversation. Really, really appreciate you making the time. Want to refer listeners who want to learn yet more to a few things. One is a wonderful piece you wrote last year for Foreign Affairs on the high price of dollar dominance. Another is an essay you wrote for us on called Bad Trade that gets a lot into these questions of the source of these structural imbalances. And then is a third is a podcast that I recorded a while back with our policy director, Chris Griswold, on this exact question of the different policy tools available. Some of the different tariff proposals out there. Senators Josh Hawley and Tammy Baldwin have a proposal for what's called a market access charge, which gets at this idea of taxing the capital flows, and a lot of other material that we certainly have on our website on these different policy tools. So we'll have all that in the show notes. Michael Pettis, thank you so much for all the work you're doing, all that you've taught me and all of us at American Compass on this topic, and for joining us on the podcast today.
And thank you, obviously, for all the work you're doing, Oren. I think it's great stuff.
We'll appreciate that. We will be back again soon with another episode of the American Compass podcast.